Jamie Dimon says the economy is on the verge of a recession and the stock market could fall another easy 20% from here. We also have Jim Cramer talking about how investors should raise cash ahead of a down year. And we have the IMF warning worst is yet to come for world economy. The market is in such a bad place, and so many people are just leaving the market or are selling, are doing everything that we've been taught not to do, but are feeling like they're stuck in this place where they have to conserve capital. They have to sell, they have to stop buying. I want to talk to you today about these different articles and tell you what I'm doing at a time like this because it is different from what we're seeing online. Now, I do want to apologize. My voice sounds a little bit weird today. I think I might have caught something in Nashville or just maybe used my voice a little bit too much during some of those live music sessions, but we're going to get through it here. I do want to say, too, there is a link underneath the video to moomoo where you can get up to 15 free stocks, thousands of dollars of free money, and it does help me out, too. So it's a great place to get some free money. Start by depositing $100, and you can deposit more if you want more free stocks. Now, the 10-year Treasury is up to nearly 3.9%, was nearly 4% earlier today, which was causing the market to drop pretty heavily earlier in the day. And this isn't the end of the day yet, but I have to make this video now. So who knows how the day is going to end up, but we have the 30-year fixed rate mortgage, 7.33% for someone with a 740 credit score. It was up at 7.4% earlier today. And if you drop down a little bit, you can see up to an 8% mortgage rate, which is insane. This is really, really high, and it's causing a lot of people to probably rightfully point out that the market probably will collapse just because people can't pay for these kinds of home prices with these high mortgage rates, which is great for these kinds of cash buyers if you're someone that can buy a house in cash, or even if you assume that the Fed's going to lower rates at some point. If you can make the numbers work now where it cash flows, you can probably refinance down the road. The DXY also was pumping up earlier today, nearly 114, now down to 112.5. It will be interesting to see with earnings coming out here over the next few weeks what people make or what these different companies make because of constant currency. A lot of these global companies will lose money because of the fact that the dollar's high compared to every other nation, and we denominate in U.S. dollars. So a lot of these other nations are falling to the U.S. dollar, and it will definitely affect earnings. Now, let's get to some of the more interesting things. First of all, the Bank of England forced to buy inflation-linked bonds. So we had heard last week that Bank of England was forced to buy bonds, basically stopping an economic collapse in their pension system. Now they're forced to buy even more with these inflation-linked bonds. Now, this is obviously another sign that the global economy is kind of collapsing and crumbling around the U.S. and in the U.S., I suppose, too. But this is a really tough time, and they're forced to continue to go out and put more money into the system. So it will be interesting to see what the U.S. does if they continue to make it worse for all these other countries and just try to prop up the U.S., or if they do get a little bit less aggressive in these rate hikes. Now, Jim Cramer just said investors should raise cash ahead of a down year. This might be a good thing that he's saying this because there's a running joke that you should always do the opposite of what Jim Cramer does. Now, that's just a joke, but it has been shown to be right a lot of the time because he does echo investors' feelings, and oftentimes investors' feelings are the opposite of what they should actually be doing, right? Being really greedy when markets are going up, being really fearful when markets are down. Now, I don't believe this is a great idea. What I've been doing all year is just dollar cost averaging. And I talked about at the beginning of the year, I had a significant amount of cash sitting around and how I was deploying it, but I wasn't going to go buy the dips super aggressively. I was just going to continue to dollar cost average throughout the year. And so far, that hasn't been horrible. I mean, yes, the market's down, but I am getting lower and lower prices. And I think what's important is typically we see the market bottoms before we actually see the economy bottom. Stocks have usually bottomed about 6 months before the economy has bottomed, and as much as 10 months before the economic decline is over. This is coming from Forbes. The reason for this is people try to price this in early. They don't want to miss out on the upside, so we try to buy in before we've seen the worst of everything. So right now, we only see bad things ahead. This could easily change, right? He just says, again, what people are thinking, essentially, a lot of the time. He very rarely takes a contrarian stance. So when you see nothing but bad in front of you, that means the market has priced that in, typically. And they haven't priced in much good news. So I wouldn't be raising cash necessarily. I think there's definitely a chance that we could fall further, but I wouldn't be going out and selling assets at these prices. Even if I did think that we could fall further, I would be working my tail off to make more money on the other side. Now, I realize not everyone can do that, but that's where a lot of this comes down to preparation. Now, Jamie Dimon also says that the economy is on the verge of a recession and the stock market could fall another easy 20% from here. Now, he talks about why this is in this interview, but a couple different things to pay attention to. First of all, he says that it could fall another easy 20%, right? Of course we could fall another 20%. We could fall 50%. We could fall 80%. What are the chances of that, though, right? What are the chances that we're going to fall 20%? Well, it's possible, but that's where you have to pay attention to the wording. He says it could fall another easy 20%. He's not saying that's likely, and while he is a big person in the financial industry, a big pundit, the fact is that he is not the be-all and end-all. He says in this interview he doesn't know where markets are going to bottom, but they could fall more. Now, I have to say, he does have some kind of thing to gain from saying a statement like this, right? Their investment revenues, I'm sure, are down over the last couple of years, right? They have less IPOs, less SPACs, less people investing with them, I'm sure, as well, making less money. So saying that you could fall another 20% keeps people interested. They look towards him for guidance, and if he's saying we could fall another 20% and then they sell and then they buy back in and they do more activity, that could benefit their trading. Just something to pay attention to, right? It keeps people wanting to keep their money with him because he's got some kind of inside knowledge. If we do fall a little bit further, then you could say, hey, we could easily go up another 20% after the market starts to turn around, and then people think he's a genius or something like that. Now, I could always be wrong, right? Maybe he's not trying to do this or anything, but I think that just saying that the market could fall another 20% is pretty obvious. And then, like I said earlier, IMF warns worst is yet to come for world economy. They lowered their growth outlook for 2023 and suggested interest rate hikes could spur a harsh global recession. The International Monetary Fund said on Tuesday that the world economy was headed for stormy waters as it downgraded global growth projections for the year. So they lowered them pretty significantly from about 3.2% to 2.7%. This is for next year. And at the beginning of the year, they said that they expected 4.4% growth in 2022 and 3.8% in 2023. So they continue to lower them. I don't think this really holds much value. I mean, this is kind of like the Fed saying that that inflation is transitory. Them saying, yeah, we're going to grow 4% or 3.8%, no, 3.2%, now 2.7%, right? Of course, the market's going to price this in, but I don't think it really affects us as investors because I don't think they really know what they're talking about much more than any of us, right? It's hard to tell where the economy is going to go and what all these different puzzle pieces are going to do a year down the line. We don't know what's going to happen. So I think right now, my focus is on continuing to dollar cost average. Now, I will say I'm not just buying anything blindly. And this is just an example with Fubo TV. I haven't looked at Fubo's business that in depth recently, but these are the kinds of stocks that I don't want to buy right now for a couple different reasons. If you look, and we'll talk about crypto in a second, right? Their revenue is increasing, but then they had a down quarter. And maybe this is just one down quarter in revenue. Maybe it will continue. You don't want to be in a growth company, though, when it starts to drop off. And more importantly, more predictably, these kinds of companies have to continue to sell shares or dilute shareholders. You can see that they grew share count a significant amount. I mean, we're talking about, 28 million shares out of 157. So they diluted 15% or something like that in a quarter. They have negative cash flow. They have decreasing cash while they're increasing debt. So that's a double whammy when debt is going up and the share count is going up. These are the companies I don't want to buy, right? Because they're not in a great financial situation, and they're putting you at a higher and higher risk of losing all your money because of some kind of bankruptcy. But even if they don't go bankrupt, they are putting themselves in a worse and worse situation moving forward, right? With raising debt costs, and even if debt costs weren't rising, like percentage-wise, right? They're going to have to pay higher and higher amounts of debt. You're making less and less if they ever become profitable. Even if we get through this recession, the fact is that they're going to be in a tough spot compared to a company, let's say Google, right? Google is still in a tough position with their ad business, but their revenue is still increasing each year. Their EBITDA is still high. They still have cash flows. They're still buying back shares. They still have a very high return on capital employed. They still have a great cash position. So even a company like this that maybe isn't growing as quickly as they were before, not even close to as quickly as they were before, they're still going to be fine once we get out of this and once the economy turns around. While their price is going down, and it's probably for good reason, the fact is they're still going to be fine after we come out of this kind of recession. Now, if you're looking at something like crypto, I think crypto is still worth dollar cost averaging into. Now, I'm sticking with Bitcoin specifically right now, as I've said all year round, but take a look at what would have happened if you had started dollar cost averaging 5 years ago, right? You'd be up 300%. Now, maybe you're saying that's cherry picking. Let's go 3 years back. Okay, you'd be up 134%. What if you went 2 years back? A lot of people think, oh, well, if you went 2 years back, started buying in 2020, you would be down. No, you'd still be up 13%. How about 1 year? And a lot of people will be surprised by this. Yes, 7% down, only 7%. If you had started buying near the peak of the market last year, 7% down. And maybe part of that's because you would have been buying at some of the best times, but part of it's just because you're not buying on emotion, right? You would have been buying at bad times here. Back in June, you would have been buying at really good times because you would have been buying actually lower than we are now. But the fact is, if you don't just throw in a lump sum right up front, but you just slowly dollar cost average, you're going to do fine. Even if you look 6 months back, you'd be up. So I'm going to continue to dollar cost average in Bitcoin, try not to be emotional, try to invest similar amounts or the same amount for a consistent amount of time. And the fact is, Bitcoin has actually been pretty non-volatile. When you compare this to the treasury markets, right? Treasury markets are going up pretty significantly. U.S. Treasury 10 years at 3.9% and has been spiking all year. Bitcoin has been pretty non-volatile over the last couple months, right? So it is interesting to watch. Bitcoin's still right around 19 to 25,000 all summer long and all fall so far. And we still do have some different projects like Ethereum that I still think are going to do well in the long term. I'm just not dollar cost averaging yet, but I'm getting closer to. You can see I just made a video on this yesterday, how the Inferno is here, and they've been burning more and more Ethereum over the last couple of days. We went from 13,000 Ethereum issued since the merge, which is nearly a month ago now, to now just 8,000. So when the network is used, you can see this kind of deflation that happens pretty quickly. We had 5,500 Ethereum burned, or right around 5,000, just in a few days. So that's pretty cool. So there's still going to be innovation. There's still going to be money to be made, and companies are going to continue making money, hopefully, as well, if you're in the right companies, even with a recession. But don't get scared. Don't let people throw you off of your investing plans just because they say that you should raise cash, or we could fall another 20%. Now, that's not financial advice, but it kind of is, right? Don't let other people influence your decisions, and you'll probably become a better investor for it. Now, of course, you always have to update your line of thinking. If things get way worse in the economy, we could fall further, but that's why I'm just saying that I am consistently dollar cost averaging, right? We could always fall further, but a lot of these companies that I'm buying will be fine. A lot of these cryptos I think will be fine. And years down the line, I'll be happy that I was investing in some of the darkest times where people were so worried. Thank you so much. I appreciate it. And I will see you in the next one. Check out moomoo underneath the video. Bye.